Understanding your operating working capital is super important for IB interviews and finance majors. We're going to break it down in under 2 minutes. Now, first of all, there is a difference between your working capital and your operating working capital. It's in the name. Your working capital is just your current assets minus your current liabilities. Your operating working capital is your operating assets minus your operating liabilities. So no marketable securities, any cash lying around, or basic stuff that's not operating like that. Now you can think of working capital as the amount of capital or resources you need to continue funding your operations. So let's say my operating assets, aka my resources, are growing quicker than my operating liabilities, aka the funding for my resources. Well, that's going to mean that I'm not going to have enough current funding to back up my current resources. So in order to get that, I need to pull capital into my business, aka your operating working capital. And in most cases, this is why a positive net operating working capital on the cash flow statement subtracts from your cash flows, because it's money that you now need to allocate to continuing your operations. Let's check out a quick example. Let's say my accounts receivable increases, which means I performed a service for a customer, but they have not paid me yet. My operating assets is going to increase because it's accounts receivable, and my operating working capital is also going to increase because think about it, they did not pay you money. You just performed the service. So you need additional resources to continue operating the business because you've recognized the revenue, but you have not gotten any cash for it. And that's the reason why having a positive operating working capital could actually be bad, because it might show, if it's very large, that your company is tying up too much of its resources in its assets. Like they have too much accounts receivable, or they have too much inventory, etc. Now, a negative operating working capital can also be a good thing if your company, let's say, has a high turnover product, or we're looking at something like Amazon, where you're literally receiving your cash from your customers before you have to pay your vendors, which would just mean your accounts receivable is decreasing at a quicker rate than your accounts payable is decreasing. And these are just examples to show you that how you view a company's operating working capital really depends on the situation and the type of business.